today, joining us on our August AGECO market update. Today we will have John Robinson and talking about cotton market update. Then we will have Mark Welch. He will talk about grain markets, and finally David Anderson. He will present livestock markets. So as I told you all before, please, if you have any questions, just ask as many things as you want or write them in the chat. Okay, Don, whenever you want to start.
All right. Thank you, Pancho, and good morning to everybody. We're going to go from, I think, from worst to best. So here we go. The cotton market this morning is the futures contract for the harvest time prices is hovering above 70 cents. It had been wallowing in the upper 60s in the more recent weeks. And you can see there since March, it's taken this big slide from the mid 80s down to the low levels of where we are now. The most concrete reason for why we're this low is because the speculators are selling the market outright. That's, if you look on the right-hand side of this chart, there's a downward green spike. Yeah.
We cannot see your slides. At least I cannot see them. I don't know if the rest are the same.
Oh, no.
So
I don't know. That may be an issue with my old laptop. Then I'm not sure how to.
We can see the cotton market update, like the first slide, but
the first slide.
That's the only one, and it's still there.
Well, okay, then it's not advancing. I can state things quickly without necessarily using my slides, Pancho. I'll just do that in the interest of time.
If you want to send them to me, I can, share them very quick here.
I'll do that after my remarks. So basically, the cotton market has been down. It's still down. It remains down because there is a large group of speculators, hedge fund managers who have made a bet that the market was going to go low and go lower than it is now. And so those people have sold cotton futures in anticipation of even lower prices. Those people are still hanging on to that net short position. Now, I find that amazing given the troubles that the market's had, given how hot and dry it's been, and given the spread of the drought monitor map, the yellow and the red over the northwestern half of Texas. I would think that anybody betting that prices were going to go lower, I would think they would be scared out of that position by now. USDA came out with some rather bullish numbers a few weeks ago, where they cut their estimate of the crop from 17 million bales to 15 something million bales in anticipation of the impact of this hot, dry weather and higher abandonment and lower yields, etc. They gave a very bullish report by cutting the supply side. Now, why that didn't scare those speculators out of their bearish bet, I couldn't tell you, but they're still hanging on to it. So it remains there. On the one hand, it's like a wet blanket. It's the reason prices went low. It's the reason prices have stayed low. But on the other hand, it's like a coiled spring, in that if something, an upward move in prices triggers buy signals, then there may be an avalanche of buy signals. Or if something worse happens to the crop, like a hurricane, or just more reports of hot, dry weather and greater expectations of low yields and higher abandonment, and dryland fields that were kept because of the stand count. The stand count was adequate, but they won't make the bowl count when the insurance adjusters come back around and take bowl counts. a lot of that stuff's going to probably get shredded. Well, when the market kind of finally anticipates, yeah, the supply isn't there, they're going to cut even more. And the supply side, the expectations of the supply side get tighter. Then I think these speculators may get out of these short positions, which is to say they're going to buy back futures positions. They're going to buy futures contracts to settle up, to get out of the position that they're in. And that could be a whole bunch of buying, which could push the market higher. If that was to happen, I would think it would happen in the next couple of months when things are still kind of uncertain and volatile about how big or how small the crop is. So what I'm saying is I wouldn't be shocked if we had a 10-cent rally. The traders would call it a short covering rally when these short speculators buy their way out of the position that they're in. And that may shoot the market up to 75, 78, even 80 cents, which if that was to happen, I would look at that as sort of the last gift, if you want to call it, or the last opportunity that this market is going to offer anybody that wasn't priced before. I hope they sell when the market is at 79 or 81, or I hope they don't sit there and think, well, it's gone up to 79, where I'm just going to sit and wait for it to go up to 85. I don't know that would happen. And if it did happen, I don't know that it would last all the way to harvest time. Fact is, I doubt it would last all the way to harvest time, because these supply-driven kinds of market behaviors are often volatile and short-lived. So anyway, that's the only good news I have in the cotton market, is that we might have some short upward price movement that would be quick and volatile and give a very kind of passing, fleeting pricing opportunity, and I hope people take advantage of it when it finally ends up happening. The last thing I'll say is, we have an election coming up. I don't know what the market is anticipating. The polls are pretty tight between the major candidates. I would say if the market begins to expect that there's going to be a second Trump administration, not to get political, I would think that would be taken bearish by the market. I would think that would weaken, particularly agricultural commodity futures markets might, anticipating more tariffs, or tariffs as a policy, which is some of the announced policy of some people representing the Trump administration or the Trump campaign. There may be some negative influence on the demand side in anticipation of the political outcome. So that's a possibility. Otherwise, the demand picture seems sort of weak and uncertain, the way it's been for the last 6 months to a year. I'll just leave it at that, Pancho. And if anybody has questions, and I'll send you my files in case anybody needs it. There
Excellent.
We go.
Thank you, John.
Sure, thank you.
So Friday market was about 67 cents. Today is close to 71, I think. Is that, John, part of this price going up because of the weather?
Yeah, I think, the market went up just a little bit, even though we had the most bullish supply and demand report from USDA that I've ever seen. They trimmed the U.S. balance sheet. They cut 1 million bales or 800,000 bales off of the ending stocks. That's bullish. The market should have been limit up based on what USDA did, and it went up a little, and then it was down the next day, and now it's back up over 70. So I look at that and I say, if that's all we're going to get from the most bullish report I've ever seen, then the market is concerned about other things too, like weak demand or tariffs or something. It just makes me wonder what else is the wet blanket I don't understand why why we wouldn't be at 75 cents given the supply and demand report we had and how hot and dry it's been since then. So.
Right. Thank you, John. Any questions for John? Mark, do you want to start your presentation?
You bet, Pancho. Glad to do so. Let me know if these slides are showing up okay.
So far, yes.
All right, and they're going to change, I hope. Okay,
Yes,
good to be with you. Again,
thank you,
Pancho,
Mark.
thank you for getting us organized, and for all of you joining us here online today. As John was mentioning, any kind of follow-up questions you have beyond today's program, love to hear from you, and maybe go into a little more depth on some of this information, or maybe touch on things that you're interested in that I won't even cover here today. I'm going to focus primarily on the feed grain market, especially on corn. Setting the pace for many of our other grain markets. Currently, what's going on in the world, and just looking where grain prices have trended over the last couple of years. That's a 4-year chart of Texas cash grain prices. And we were on a strong upward trend coming out of the summer of 2020. We had a short grain crop in the U.S. Brazil had some production problems. China was buying feed grain. Then on top of that, Russia invades Ukraine in early 2022, and the markets take another leg higher. Well, you can see the supply and the demand adjustments that we've made since that period of time. And now we've got those prices reset significantly lower, not as low as they were 4 years ago, but we're kind of getting back in that territory. One interesting note of prices last week, the price of wheat was actually below the price of corn in the markets that we monitor across Texas. And that's a pretty unusual circumstance to see cheap wheat to that degree. And one challenge we've got in wheat, and we could talk about that more if you're interested, is a relatively slow level of export movement of wheat out of the Gulf in Texas. We just have such limited wheat moving to export markets. It's really creating some a lower basis and some pretty downward pressure on our Texas wheat prices. Look at the potential for the U.S. corn crop, and I think over the next several months, that's going to drive our price trends. We could see some acreage adjustments coming out of weather issues, but just look at what the drought map looks like in 2024 compared to where we were a year ago. And as you look at those maps, the coverage levels is pretty dramatic. There's of any area in drought in that north central region this last week was 36%. That compares to 2/3 of the area a year ago. And then look at all the dark red and that even almost brownish color on the map in 23 compared to where you find that in 2024. And those are the areas, the extreme, you don't want to see yellows or browns. That's not good. But the real yield impacting drought categories, the ones that are really going to start having a significant impact on production, are when you get into those extreme and exceptional drought categories, the red and then that dark red or even brown. And you see that on the map today, really over there in southeastern Ohio. That's not prime corn growing country in southeastern Ohio. That's more Appalachia over in that part of Ohio. The corn growing area up in the northwest is kind of yellow, but certainly the drought impact this year very minimal compared with where a year ago. And what's interesting about that, a year ago we set an all-time record high corn yield of 177 bushels per acre. So we had a drought map that looked like that, and we still set a record corn yield for that 23 corn crop. Corn condition ratings this year compared to average, and it's a little hard to see maybe the difference. If you create an index out of the share rated very poor, poor, fair, and so forth, and you can come up with a number per week, and you can compare this week's ratings compared to what they were on an average corn crop. And that average goes back to 1980. And this year's corn condition ratings have been consistently above average for this growing season, with running in the share rated in that good and excellent category just below 70%. as we've gone through July now and a good part of August. So 68% of the crop in that good and excellent category, which would be better than average. Now, let's focus in on that just a little bit. And as we zoom in on how those comparisons have changed the scales, now this is what the average index would look like. Given an average or normal kind of growing conditions, you would expect that would support a trend line yield for the current growing season. And if you just look at what that projection would be, just given trend line growth going back to about 1980, that would suggest a yield in the U.S. this year of 181 bushels per acre. A year ago, we were seeing conditions below average for the entire growing season, with the exception of maybe the very first week of reporting. And we came in with a final yield that was actually just below trend of just a little over 1%. But again, that 177 bushels per acre was still an all-time record high. And then compare national crop ratings this year. What do those index numbers look like this year compared to average and compared to a year ago? And you can see the degree to which we have ratings that are running well above where they were in 2020. Where they were in 2023 and even above average. Now, you would see some decline this time of year. That's perfectly normal. Again, we're kind of the heat of the season, the tail end of the growing year. To see those condition ratings slip a little bit is not unusual at all. But that we're staying that much above an average kind of index would, to me, add credence and support to USDA's recent yield estimate for the 2024 corn crop, 183 bushels per acre. Just an outstanding number. And we'll see how it plays out. But again, I think our index information would add support to what the USDA's projection at this point. On the demand side, as Dr. Robinson was talking about cotton, we've got some challenges when it comes on corn demand. Corn for feed and corn for fuel. Those are our two biggest categories. And we'll look at fuel first. And you can see the strong correlation between ethanol consumption, which is the green line, and it runs at about 10% of what overall gasoline consumption is. And that makes sense given the 10% ethanol fuel mandate in the U.S. And we're just not getting back to those pre-pandemic levels when it comes to gasoline demand. And these are by the current corn marketing year. And projections then for 24, 25, we just haven't rebounded back on the gasoline side. And I think that's going to certainly create some headwinds and some challenges for us getting ethanol demand back up to where it was prior to the pandemic. So it seems to be capping growth on the fuel sector. And I'm always interested in what Dr. Anderson will share when it comes to our livestock markets, because again, feed use is the number one use category for U.S. corn. And these are numbers that are created by USDA, a grain consuming animal unit index. So you have your cattle industry down here at the bottom, you have your pork industry is red in the middle, and your poultry industry up here in yellow on the top. And over the last 4 or 5 years, the total of those livestock and poultry inventory numbers have been on the decline. And we're projected in 24, 25 to be slightly lower than a year ago. And what's driving that lower? Well, it's primarily from the cattle sector. So I'm very interested in of course, the cattle on feed numbers and projections in that part of the sector. Poultry rebuilding a little bit, pork showing some small gains, but yet at this point, based on these grain consuming animal unit numbers from USDA, we just don't have that larger animal sector to drive feed use. Another problem that we have is over the last 10 or 15 years, the trend is down in energy feed consumed per grain consuming animal unit. Now it's up a little bit this current year because corn is really cheap. And so maybe you can put those animals on feed a little earlier, keep them on feed a little bit longer with low grain prices. But that trend over time is for a lower amount, genetics, feed efficiency. The industry's just getting a lot better at putting, pounds of meat with fewer pounds of input, particularly grain. They're getting better and better at it. And so you combine those two factors, again, it's a limiting to the growth potential in the most important use category when it comes to the corn supply and demand balance sheet. Exports, we've got our challenges there as well. Up a little bit this year compared to a year ago and compared to the prior years. But I've got the U.S. exports in the black line to contrast the accumulative export competition that we're facing in the world. This goes back to 2000, so the last 24, 25 years of data. And there have been twice on that chart, the U.S. was not the number one exporter of corn. Brazil beat us in 2012. Of course, that's the big drought year in the Midwest. And then they beat us again in 2022. Now, we're back on top. We are now exporting more corn than Brazil in this current marketing year. But again, the cumulative export competition from Brazil, Argentina, and still from Ukraine in the middle of a war, they're still able to be a significant competitor when it comes to the U.S. in the world corn export market. So just a quick look at the balance sheet, and we got the same problems that we're having trouble with demand keeping up with supply, in that if we have, even with fewer acres this year, harvested acres are down significantly. With an all-time record high yield, production is actually down a little bit. But when you start adding higher levels of carryover stocks, because demand is not keeping up with that growth in supply the last couple of years, we start to see that stocks to use ratio goes up. The number I use is days of use on hand at the end of the marketing year. How much grain is left over from one marketing year as we go to the next? Well, we've gone from a 36-day supply to a 46-day supply, now looking at a 51-day carryover. And if we're increasing our supply by almost 2% from a year ago, and use is growing moderately, slowly, but yet if the weather cooperates, we're just not keeping up on the demand side as we're seeing on the supply side. And then again, it doesn't take a PhD in economics to figure out the price impact of supply growing faster than demand, and that's putting then some negative input on prices. Putting that price projection for 2024 in kind of some historical perspective, as we get that days of use on hand number bigger, obviously the price is going to go down. For corn, the critical kind of the dividing line of high prices versus low prices is this 40-day carryover. And you can see we've in 21, 22, we were relatively high prices. We were relatively tight supplies relative to use. Now we've eased that concern of supply relative to use. We've gone to a 46-day carryover, a 50-day carryover, and we're kind of back down to this $4 corn. And if you look at where that kind of relates in previous years, what are the years that would be kind of the analog years of that? 16, 17, 18, 19, that kind of heavier carryover. That's kind of where we are in 2024. Put that in a more of a global perspective. Again, here's our U.S. carryover up to about this 50-day carryover. How does that relate? 16, 17, 18, 19, these relatively high carryover years. Globally, we're a little tighter, marginally higher this year for the 2024 corn crop, but not a significant rebound, but we stopped getting tighter. And so I think this just demonstrates the degree to which the U.S. continues to drive the world corn market. And we're seeing prices, if you look for an analog year that the December contract kind of is trading like, go back and look at 2014. 2014, we were coming out of the very high price years of when? 2012, 2013. We were building supply, demand was slowing down, and we saw this kind of price action indicated by the red dots. That was the price index in 2024, and we're following, to this degree, something very, very similar. In 2014, we had very strong corn condition ratings, never fell below 72% on the good and excellent categories the entire year. This year's not quite that good, but we're at a higher projected trend line yield level in 2024 than we were 10 years ago. But again, very, very similar patterns as we look at, and maybe look at where we may be prospectively of where these prices might go as we're heading again toward the harvest season up in the Midwest. So again, I think the biggest feature of our grain markets is if weather cooperates, the bottom bullet tied up here to this one, that's giving us the potential for the factors of supply are increasing greater than the factors of demand in the current environment. And that current environment is one where our growth on the demand side is challenged by economic conditions. interest rates, we may see a little relief in that regard. And, by the time we get to the latter part of September when the Fed meets again, but we still have relatively slow growth in the U.S., slow growth globally, and that does have an impact on our grain demand. So, Pancho, I'm going to stop right there. Be glad to see if there's any comments or questions we have right now, and be sticking around to hear the rest of the program.
Thank you, Mark. I appreciate it. Any questions for Mark? David, you want to start your presentation?
How's that, Pancho?
Looks great.
Great. Gosh, you guys pretty grim. I think let's, putting those together, one thing we need to recognize is probably the role of John Robinson in driving down those corn prices. Since he's taken annual leave and isn't driving around, there went our ethanol and fuel demand, I guess, Mark. So, I was just in this conversation the other day about how, discussing these really low crop prices. Yet at the same time, as we think about the livestock side of things, those low prices, that's the feed to livestock. And that's been, I think, a real boost, particularly in calf prices over, the last year or so. But also if we looked at profitability in terms of say, hog production, chicken production, and I want to say something about chickens at the end, and a little bit of where we might be going in that competing meat area. But certainly these lower feed costs are, I think, a pretty important factor in what we're looking at in terms of prices on the cattle side, particularly, but profitability on the others. And so, but I really, I think we ought to keep that in mind going forward. Because that has the potential to, at least drive a little more production and some more production of meat, at least certainly on the pork and poultry side, chicken side, I should say. Then that gives us a chance for us to start seeing, at least from supply side driven stuff, some lower prices in terms of retail prices. Now, I titled this Summer Volatility. It's been a month since we did this, and about it was really early August, that first week of August, I guess, we saw a real sharp decline in cattle futures, particularly fed cattle and feeder cattle futures, really driven at the same time that we saw a pretty sharp decline in the stock market. And really, it's just fears. I want to argue this is, fears of some recession going on. And if you're going to be worried about that, then we drive down beef prices. And if we looked at, say, the quite a bit of the at least stock market anyway, it's recaptured most all of that. Certainly, if we looked at like the Dow or whatever. So we have not recaptured necessarily that on the beef side yet, because I think we have a couple of things going on that I want to highlight in that. So we'll kind of talk about that as we go along. And I think the first thing I want to do is talk about fed cattle prices. And if we look just over the last month, we've seen a pretty steady decline in cash fed cattle prices. I'm using Southern Plains. If we looked at the 5 market average, we'd see the same thing. Last week, we were roughly 183. I didn't quite have all the data yet to stick that in, but I stuck in a 183 for last week's average. Again, steady decline, yet we continue to have prices above a year ago. We think about this idea of kind of some summer volatility. We had the exact same thing happen last year. We saw a pretty sharp decline later in the year in the fed cattle market, which was really, I think just looking for a reason to go down at that time. I think in this case, there's some fears of that as well. And I think that's just part of it. And so I'll show a couple of charts as we go along. And one of the things in terms of the fed cattle market that is, I think, pretty interesting is that we're producing more fed beef, or at least as much fed beef this year as we did last year. And so, as we think about prices, particularly wholesale prices that might be struggling, gosh, it's pretty tough to sell more beef at a higher and higher price. So we've got so I think that's part of this overall mix, the recognition that we're producing more fed beef, or as much fed beef as we did last year, but a lot less non-fed beef. And by non-fed, I mean cull cows, and bulls. That beef production is down pretty dramatically from a year ago, and it's leading to a growing, interesting difference prices between fed and non-fed beef. So our fed cattle were still above a year ago. We still have ahead of us sort of our what we might think of as sort of a more normal fall season that prices pick up. And so we would normally see some seasonality of increasing prices later in the fall. We may very well see that, and I'll talk about that as we get in some of the cattle on feed report. If we look at feeder steers, these are 750-pound steers. They certainly took a fairly dramatic decline after the futures. You might notice though that the futures is still well below where we are looking at an assortment of these feeder cattle markets. And so prices about where we were a year ago in terms of feeder cattle. If we look at calves and lighter weight ones, I didn't include that chart this time, but we continue to have prices above a year ago across those markets, even though we've had some of this volatility going on. I think one of the things that's important to recognize is in what I've done here, because we ought to be thinking some about winter stockers, whether it's wheat pasture, oats, whatever. What I've got here is we look at these correction in prices in the lightweight animals and the 750s or whatever this winter grazing stocker thing might be. One of the things we've seen so far this year is looking at just a steer calf, a feeder calf price, a stocker cattle price minus a feeder steer price. Going through this kind of a great looking at some stocker type programs, we've certainly had a much larger spread or price difference between those lighter weight ones and heavier weight ones than we did last year, and much larger than we have on average. What that should suggest to us is that our as we've got fewer numbers, our lighter weight animals have gone up in price faster than our heavier weight ones, which means my buying price has gone up by more than my selling price has done. So that squeezes that margin. And so if we calculated this out, we'd have a much tighter margin, or we could go further, take out some other costs and get profit margin. We got a smaller profit margin suggested for at this point for some stocker cattle programs than we've seen in the past. And simply because in this part of a cattle cycle, that spread gets bigger. So one of the things that's happened, at least in this price correction that we've seen, at least some lower prices, and by price correction, I'm thinking this cash market, is it has brought down this kind of this stocker grazing, backgrounding price spread a little bit, which makes some of those types of programs look a little better than maybe they did a couple of months ago. And so I do think there remains, I could calculate up some profitable scenarios for stocker cattle without any trouble, but maybe not as big a margin as we've seen in the past. So with that in mind, I think that's one of the outcomes of these changing prices and this decline in price is to see that kind of spread decline a little bit as well. So I want to take a step further into the beef side of it. I've got here the box beef cutout for choice beef. We're basically right where we were a year ago. And so when I mentioned earlier that the wholesale market struggled a little bit, I think we have the recognition of a couple of things happening in terms of prices. One is this is choice beef, so it's fed beef, and we're trying to sell as much fed beef as we had a year ago. And that's proving sort of difficult if we were looking for much higher prices. These are pretty high prices. These are strong wholesale market prices, particularly in the face of the same amount of beef production. And so, I think that's where the struggle has been. Now, if we dug a little deeper into that, we might look at, and I'm going to use two charts here from some primal cuts, a middle meat and an end meat. And by middle, we're going to take the rib. I could do the same thing with the loins. So if we're looking for an area of beef sales or prices that we might argue, gosh, these have struggled. We ought to be or would like to be seeing some better prices. Or in other words, what would support the wholesale market to pull that thing up and pull our live fed cattle price up? Well, let's start with these primal rib values. And so what are we getting from that? We're getting the rib, we're getting, rib eyes, we're getting a lot of pretty great steaks out of this part. And those prices have, I would argue, have seen a fair amount of pressure this year. We're not a lot different than we were last year at this time, but we've had some lower prices, and certainly over the last couple of weeks, that's a pretty large price difference developing, and that's what's holding down the cutout. So we might think too about this idea of middle meats and end meats. If the middle meats are the expensive, really good stuff, the steaks and that kind of thing, this might suggest to us that maybe those are struggling in the wholesale market, which might suggest to us a little bit of switching around by consumers in what they're buying. That maybe we've got the pressure on the more expensive cuts, moving to some less expensive cuts, and I'm going to show that with the chuck, and I could show that the same if I'd have taken the round or some of those other ones. I could show you the same thing, and so we've got chuck values that are well above, or at least above where we were a year ago. Yet we've got those middle meats that aren't. And so, is this some indication of some kind of switching around by consumers? It may very well be. I think it also highlights too. If we think about going back to an inflation story, one of the things that's interesting as we dig into the data is if we looked at food away from home, that's restaurant buying. You go to a restaurant versus food at home, which implies grocery store buying. We take it home to cook. Prices have gone up, or costs have gone up much faster in the inflation data for food away from home. That's going out to restaurants versus at home. What that should lead us to do is consumers to buy more at the grocery store and cook more at home rather than going out. And we move a lot of steaks in restaurants. So I think that's part of the pressure on the rib, for instance, the primal rib cut. That we're seeing a little bit of consumer shifting around based on relative prices and relative values. And so you've got some struggling in the middle meats. We got, I think, a little more strength in the ends. But when we put all that together with the cutout, we got a cutout that's about where we were a year ago. Now, going away from those primal cuts, the primals that make up the cutout, let's take a look at wholesale boneless beef prices. This is 90% lean. This is the beef we're getting from cull cows and cull bulls. So, if we were looking for, and so this is beef that's going into ground beef. So, gosh, if we look at that, if we see people switching away, maybe we switch away from really high-end stuff, we're still buying ground beef. And because of our tight supplies of cull cows, we got record high prices for 90% lean. And so, gosh, you put that together, is we really have some differences happening within this overall beef price complex that I think is pretty interesting against this backdrop of, supplies being where they are. We certainly have some record high prices in this area and higher prices in the end meats, and continued support for really good cull cow prices because there's some demand for the beef. And I think that shows up exactly in the wholesale market. So I think Mark made some mention on cattle supplies or grain consuming animal units. That'll lead me right into the cattle on feed report that came out Friday afternoon at 2:00. And I think there's some interesting stuff there. If we look at, I'm going to show marketings in terms of daily average marketings. And we actually marketed fewer cattle last year, slaughter suggested that our daily average fed cattle slaughter was lower in July than it was the year before. But because the way the calendar falls, we actually marketed more animals than last year. But if we divide by days, it's actually a little fewer. So I think this daily average is a little bit instructive that, boy, we didn't move as many animals every day this year as we did last year in July. And that what that does is that that's part of the story. And why do we have more cattle on feed that I'm fixing to show you? Why do we have more cattle on feed than a year ago? Part of it's coming from this marketings that we didn't market or slaughter as many fed cattle as a year ago. Placements were up. Placements actually were up about, oh gosh, I think it was 5.5% compared to a year ago. You know, it's been a bit of a strange year because of the calendar and kind of when holidays and weekends fell. But what I would point out is we normally see an increase in placements from June to July. We got that this year. We got a little stronger growth than usual. Part of this what appears to be really this strong growth in placements is because we're comparing to a year ago that was really small in July. So the percentage change looks more impressive than maybe it really was, but we did place more cattle. So the combination of reduced marketings and more placements gives us slightly more cattle on feed than a year ago. So for Mark, our grain consuming animal units, we've got more cattle on feed. If we dug into this a little more, we would see actually for cattle on feed more than 90 days, we've actually got fewer than we did a year ago. Our numbers of cattle on feed more than 120 days, which really sort of tracks this longer feeding periods. We keep cattle on feed longer. We feed them to heavier weights. That's coming down also, although it's ahead of a year ago. But, for the time being, we still have more cattle on feed than a year ago. We are feeding to heavier weights. That's probably boosting our grain consumption, our corn consumption. But at the same time, the longer term trend is for some more efficiency, better gains. And so there's a lot of little offsetting factors, but no doubt we do have a few more cattle on feed. We're feeding them to more days. For more days, we continue to feed to heavier weights. And, certainly less expensive corn is contributing to that and is part of that. So, that's sort of where we are on the corn side. I'm going to mention two other markets for something different. I want to point out something on the lamb side. I think it's been a pretty interesting story this year in the lamb market that we continue to see every week. We're producing more lamb than we did a year ago. Now, the data comes out as lamb and mutton combined, but we continue to produce, for a bunch of weeks this year, more lamb than we did last year. Weights are a little bit less or about the same as a year ago. It's actually coming from the slaughter side. We're moving more animals. So I think if you were looking at the lamb market in terms of prices, we've seen our summer kind of seasonal decline in prices pretty sharply. In fact, in some markets for some weights, a larger seasonal decline than we would normally expect. But, I think one of the encouraging things is that prices have hung in there a lot better than we might have expected with this kind of growth in the lamb market. I think one of the concerning things is if we looked at on the slaughter side, we're actually sending more ewes to market. Our mature sheep slaughters ahead of a year ago. That implies fewer sheep next year than this year. And so, again, that we're producing more, yet prices have held up pretty good. I think has been fairly encouraging, but that's a lot more animals going to market than maybe we expected, and certainly more lamb production compared to a year ago. I think that's a little bit of a surprise in the market as well, given numbers. So, and certainly implies that we may likely see less come the January 1 inventory next year than compared to this year. I'm going to hit one other market that we don't talk about very much, and that's chickens. And I'm going to do it with one chart. This is the number of chicks that are placed for broiler grow out every week. So, if we tie together a bunch of these things, a heck of a lot cheaper feed, we certainly have higher wholesale chicken prices, and we combine those higher prices with cheaper feed, I think we've really seen a real boost in broiler chicken profitability. And I think it's showing up in not only the number of eggs set for broiler chicks, but also now that the number of chicks being placed for broiler grow out is starting to see some real increase over a year ago. So one of the things I expect to see is, so Mark, for your grain consuming animal units, we're going to have more chickens to feed. I don't expect the trend to change in terms of heavier weights. Just like we see weight growth on the cattle and hog side, we see weight growth on the chicken side as well. So, more chickens placed, feeding to heavier weights should boost some of that chicken production. So I think one of the things we're going to see while we have declining beef production in the long term, I think this argues for some more chicken and some more competition on the beef side for more chicken production in the coming months and into next year. So I thought this was pretty interesting to point out. You sure see a real seasonal decline in chicks placed that hits pretty soon, kind of into October. But so far, we've got a pretty strong increase in the number of chicks placed for grow out going on. I think that's my last slide. I thought I'd end with something different, maybe tie us together a bunch of things. But anyway, I'll stop there and see if I can end the show. See if I can stop sharing.
Thank you, David. I appreciate.
Oh, you're welcome. Great to be with you, and thanks again.